Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. Here today with two very special guests, reoccurring fan favorite Ali Hamed of CoVenture Capital and Andrew D'Souza, founder and CEO of Clearbanc. Guys, welcome to the podcast.
Excited to be here. Nice to meet you.
Yeah, thanks for having us.
Awesome. Andrew, what is Clearbanc and what problem did you guys set out to solve?
Yeah, Clearbanc is creating a new way for entrepreneurs to fund their growth. I think both myself and my co-founder have been through the ups and downs of raising a ton of venture capital, having to deal with the process of doing that, and then the ongoing sort of board management, investor relations. And Michelle, my partner, has kind of bootstrapped every company and had to deal with the sort of uncertainty of not knowing, how aggressive to be and how to be able to access, next month's funding and payroll when you're bootstrapped. And so what we're trying to do is say, look, on one end of the spectrum, you've got equity, which is expensive, takes a lot of time to raise, and it's really good for funding uncertainty. On the other end of the spectrum, you've got debt, which is, also takes a lot of time to raise, can be pretty restrictive for a founder, sometimes comes with things like personal guarantees and covenants, and it is really designed for like unlocking liquidity from assets and fixed assets, which fast-growing companies don't have a lot of. So we're trying to create something in between where if $1 in equals $2 to $4 out over 6 to 12 months, we're a better alternative than equity or debt to fund that growth. So that's what Clearbanc is. We're trying to create a new asset class, new funding model for entrepreneurs.
And my understanding is that you didn't start this way day one. Can you talk about how the business has evolved over time?
Sure. Yeah. So, we started with this vision of helping entrepreneurs through financial services. We looked at, the entire landscape of who considers themselves entrepreneurs, whether those are freelancers, self-employed, gig economy folks. We did a partnership with Uber in the early days, tried to figure out if Uber drivers are more like entrepreneurs or more like part-time jobs. Found that most Uber drivers think of themselves as part-time jobs. Some of them think of themselves as entrepreneurs, but they're not really capital constrained. They're more time constrained in terms of how much more money they can make. We did a lot of work in the vacation rental space with Airbnb and HomeAway. We actually found a lot of folks that are building sort of property management businesses on top of these vacation rental platforms. Still think that's a really interesting vertical, and we funded a lot of those businesses, but also found that the data that exists in that ecosystem is a little bit more messy than we'd like, and it's not, and a lot of those, it's hard to find those entrepreneurs. We know there's a lot of them out there, but it was hard to kind of unveil them all. And where we've evolved has been primarily e-commerce, consumer brands, people that are building products and selling them to consumers. We've evolved to really fund their customer acquisition, which is what a lot of them go out and raise money for. Part of the background is Michelle, my co-founder, is on the Canadian version of Shark Tank. And so we would see all of these pitchers that would come on saying, hey, I've invented a brand new widget and I need $100,000 and I'm willing to give up 25% of my company to do that. And I need to spend that $100,000 on Facebook and Google ads. And we were just like, I don't know if I want to own 25% of this company forever. You're going to resent me when your company's worth, hundreds of millions of dollars maybe. And do I really want to sit on the board of this company? Do I really think there's an exit? It's a family business. They're going to continue to, they never want to sell it. But how do we fund your customer acquisition? We want to work with you and want to help. How do we fund your growth without necessarily taking a piece of your business? And so that was part of what led to this model that's really resonating. And Ali, you've been thinking a lot over the past few years about cost of capital, about alternative financing models. You've called out in a positive way or encouraged VCs to be a bit more creative about different funding models. Trace a little bit your ideological evolution as to some of these topics, and then leading up to when you discovered and got involved with Clearbanc.
Yeah, no, one of the things that we often tell people is we think it's insane that, so companies take longer to go public now, right? So they become like these $500 million companies or multi-billion dollar companies while still staying private. And, if these companies had gone public, if you look at them, they'd have much more sophisticated capital stacks than they currently have. And if you look at the world today, you have these businesses becoming worth 10, 15, $20 billion in enterprise value on the back of preferred equity and convertible notes. And so it's pretty obvious to us that we need to change the way that we're funding companies. And I don't think venture capital is going away. Like venture capital plays a tremendously useful, but you've got to think of other ways to fund these companies. And if you're an e-commerce business and you know that if you put $1 on Facebook, you're going to generate $5 of revenue, like there's no way you should be using equity financing to do that. That's just stupid. You're basically selling part of your company for money that you know you're about to get right back. And even if you're paying to have a more expensive yield on the debt, you're not really comparing it to other debt. It's really just a replacement of equity. And the same thing's true for like SaaS companies. Like if you're a SaaS company, you have your recurring revenue, but a really long payback period, why do you keep raising equity financing to dilute you over and over when you really probably could borrow against that recurring revenue where the churn's really your an analogy of a default rate? And so if we look at all these different models, you know, investors have been really, really uncreative in how to provide financing to these businesses. In the case of Clearbanc, they can fund the really, really fast growing startup. They can also fund sort of the business that does a few $1 million in revenue or even high hundreds of thousands of dollars in revenue by giving them that ability to scale without wondering, hey, look, if I'm pursuing growth, maybe I'm going to risk my business and risk making payroll. So it's just sort of the broader problem of we have to get out of our heads of the only things that exist in the world are seed, series, and series B rounds and start thinking like, what is the right type of capital for this situation and be a little bit more flexible how we structure it. So it's the right solution, not just sort of the everything's a nail and we have a hammer.
Yeah, I think just to jump on that point a little bit, you know, I would love for venture capital to sort of get back to the roots of funding technical risk, right? You know, I put $1 in and I don't know whether I'm going to get $0 out or $1,000 out over, you know, tomorrow or over 10 years, right? I think that is where, you know, funding things that move humanity forward, funding R&D, funding product development, and every company goes through a moment or several moments of its time where you are taking sort of, you know, you're really funding uncertainty, right? You're launching a new product, you're trying a new channel, and I think that's a perfect use of equity. But I would love, you know, if in 5 years we're you know, we get back together and we're, you know, people are looking back at the like 2018, 2019 timeline and being like, I can't believe that founders sold 50, you know, 80% of their business before an IPO or an exit, mostly to fund Facebook and Google ads, right? Mostly, so you're basically giving your money away to Facebook and Google, or you're giving your company away to Facebook and Google, which feels...
And one of the problems that Andrew's speaking to is venture capitalists, in many ways, are just misaligned, right? And they only can invest equity. So, of course, a venture capitalist is going to go to an entrepreneur and say, hey, you know what? You don't want to take on debt capital because there's covenants, there's corporate guarantees, and there's this and there's that, because they want to be able to keep deploying equity financing. They want to be able to keep putting more business money into the business. And they, like, at a certain point, a reasonable payback period is actually good for the VC funds that are sort of $1 billion plus and are so focused on ownership. What Andrew and Michelle are doing is giving his entrepreneurs an alternative option. But Andrew, I love how you kind of described, holy cow, you're giving like 50 to 80% of your company to Google. It's just crazy.
Why couldn't VCs do this now?
So there's a couple things, right? I think one, their structures are set up for like long-term investments. Their LPs are not set up in that way. Now they could or couldn't restructure when they raise new funds. I think it's more about, we have a 50-person team, you know, half of which is, you know, engineering, data science, right? We've built a lot of infrastructure and technology to be able to do the volume of deals that we do at the, you know, we funded 500 companies last year. We'll fund 1,500 to 2,000 companies this year. You know, it'd be like a VC firm where every associate's doing 10 deals a day. I mean, somebody could start that VC firm, but that's sort of what we've done, right? Is we've sort of flipped the model on its head and said, look, we don't really care about, you know, the pattern recognition that VCs go through of like, where did you go to school? You know, who do you know? Where did the introduction come from? Do I like you as an entrepreneur? And do I, you know, how do I feel about it? We really focus on the data, right? And it's just about like, hey, I don't care if I would ever use your product or buy your product, or if my, you know, kids would use it or like family members would use it. All I care about is, do you have a product that customers are buying, and do you have a channel that you're able to find more of those customers? And whether or not I understand that market, or I care about the TAM of the market, and whether or not I'm going to get a 10x to return my fund on my one deal, that doesn't matter to us, right? We're set up so that, you know, all of our companies, right? 99% of our companies need to be successful, not 1 in 10, which is sort of the VC model. So, you know, not that they couldn't do it, they haven't done it for 50 years.
Right. And in the next 5 years, do you see VCs evolving to look more like or offer Clearbanc functionality, or will it be the interplay between you and other venture VC firms?
Yeah, I mean, I would love it, right? I think it'd be great for entrepreneurs. Our part of our mission is just like, how do we make life better for entrepreneurs? How do we let them focus on building their business rather than raising capital and managing their boards? And so that would be great. I don't think it's going to happen, but I think what we'll end up doing is probably partnering. Probably half of the companies that we fund are referrals from VCs. Either, the really good VCs want to fund technical risk and they don't want to fund ad spend, right? The really good ones are like, hey, I actually want my money to be used in the highest leverage, highest risk place because it's expensive capital. And they want to fund the companies that are taking big technical bets that, could really move the needle. And so they refer to us to all the companies that they see that are not a good fit for their model, or maybe playing in a market that they don't know how big it is. Or even the companies they do fund, they say, look, I would love to have a non-dilutive co-investor or follow-on investor that is just adding more fuel to the fire without taking a piece of the pie. And so there's a real symbiotic relationship with us and the good VCs, right? There are, like Ali alluded to, there are VCs that are just like, greedy and are like trying to delude their founders and saying, no, let us keep putting more money into this company to own more and more when it's, really expensive and restrictive or painful capital to take.
I'm kind of curious. One of the things I think is really interesting about what you're doing is you're basically taking an asset class or sort of a body of companies that have been funded primarily via qualitative metrics, right? Like if you ask 80% of VCs who work at a seed fund to like build out like an Excel model, they'd probably look at you like you had 4 eyes. So, you're basically taking a really quantitative approach to what's traditionally a really qualitative asset class, sort of ecosystem of companies. One of the things I'd love for you to kind of talk to is like, what are some of the filters, without going too much into the secret sauce, that you guys look at right off the bat to know if a company's a fit or not? And then if there's any nuggets that you guys have gotten where there's something that you used to think was okay, but now you're like, I'll never fund a company like that again, or some of the lessons learned in that underwriting process that's gone into your model.
Sure. Yeah. So look, I think you couldn't have built a company like ours 5 years ago, right? There wasn't a consistent enough data set. So now, like especially e-commerce, direct-to-consumer brands, there are 5 to 10 e-commerce platforms that almost every brand uses, 5 to 10 payment processors every brand uses, 5 to 10 marketing channels that every brand uses. And we've built integrations into, all, or, we'll have all of those done. And so we have a real-time view. We have down to the transaction level, right? How much money did you spend on Facebook, Instagram story ads in October of 2018, and how much revenue did that process through Stripe that same month, right? Like we can actually see that and build a, pretty accurate cash flow and sort of return on revenue history of these companies. And we can look at that in real time. So we can actually say like, how is that doing? How's that trending over time? And, so what we really try and figure out is how much money should these companies be deploying? How scalable is their model? And what is the response to the input of, additional capital? What is, they spend that incremental additional dollar, how much incremental revenue does that actually drive? And we monitor that on a daily basis. The other nice thing is because we're plugged in and we're monitoring this on a daily basis, we can actually go and do, we can do a second round, a follow-on round a week or two later, right? We can literally, imagine if you could have that level of granularity in your fundraising process because it's instant and there's no friction. As your company scales and grows, we can give you better terms, better pricing, more capital as you need it. So you don't need to go raise 18 months, today of runway today. You can raise for next month, and we'll fund you again next month if you're doing well. And if you're not, then we'll just let it trail off, or you can pay us back. That's one of the nice things about being a technology driven investor.
Really, and can you say more about why it couldn't have been done 5 years from now, 5 years ago, and why it's not being done 5 years from now, but sort of the why now moment? Ali mentioned earlier a little bit about companies staying private later and how they have a less sophisticated capital stack. Ali, I'm actually curious if you can expound on that, why it's a less sophisticated capital stack, and then perhaps we can get into other reasons, why now and why not then, or why not in the future.
I guess I'll just to go really quickly. If you're a company that is $1 billion in value and you're trading on a public market, you probably have a bank line from JP Morgan that's at like L+5 or L+6, right? And you might have some assets on your balance sheet, and you probably got in a mortgage, or you probably refinanced some of the assets, or you've probably explored buying your office building instead of renting your office building. Like, you've just become like an efficiently capitalized business. when you're like a high growth startup, you're like, yeah, I've done 6 financings in the entire universe of this thing. I've like never talked to a banker in my life. And every single dollar I've ever spent in the world has been equity. And if it wasn't equity, it was convertible debt. So it's just like a different, like, order of magnitude difference in terms of how efficient you're using your capital if you're a company that's truly figured out how to access capital markets or not. And it's not even about being creative or not. It's just about like, oh my God, like you're a $1 billion company, you don't have a corporate loan. Like, what the hell? So, I don't think it's much more complicated than that. I'm going to let Andrew take the why now. Kind of curious. I know, Andrew, you talked a little bit about, well, now there's sort of these mature distribution platforms, et cetera. I know that to me, I feel like we're going through sort of this like D2C renaissance. Every time I'm taking a New York subway, I feel like, oh my God, I should start Subway Capital and just try to fund all the companies I see Subway ads for because they must be doing really well. Like, I'm curious what your why now answer is.
Yeah, I think it's the fact that if you ever thought about building a brand, even 5 or 10 years ago, you needed to do these massive media buys. You needed to go and get into, get a wholesale order at a large retailer. It was capital intensive even to get it off the ground, and it was very hard to measure, right? Shark Tank is actually a great example, right? If you think about the pitches in Shark Tank in season 1 and 2, like the first 5 seasons were like, hey, I need your help getting into retail. I need your help getting onto QVC, whatever. I need your help getting large purchase orders and getting distribution. Now it's all direct to consumer, right? It's like, I need your help on digital marketing. I need your help on partnerships, brand, sourcing. And I think this is part of the reason why VCs have started to gravitate to these, direct-to-consumer brands, digitally native vertical brands, is they're capturing so much more of the margin because they don't have to necessarily go through retailers, right? And they actually are, they're totally vertically integrated. So they own the supplier, they own the customer relationship. They, there's a story at least around lifetime value of that customer. And so from a margin perspective, VCs are looking at these as saying, look, high growth, high margin businesses, let's just put the same product that we've funded software businesses with. Where in reality, they're actually built very different. And like Ali was saying, deserve better or alternative forms of capital for different parts of their P&L. And so I think it's, if I think about the why now, it's really because we are now at scale where you can build a large company with, stitching together online platforms, online customer acquisition, online payment processing with a kind of robust system of record data that we can use to, underwrite and service.
Andrew, one of the things that I think is fascinating is you have so much data about what works and what doesn't work for e-commerce companies. If you were talking to an entrepreneur who was thinking about starting an e-commerce company and they were like, well, I'm thinking about advertising on Facebook, I might do it on Instagram, I might do it on Pinterest, like, you got all the data. Like, what would you tell them? Like, if you were starting an e-commerce business from scratch, what social media or distribution channels have you found to be most successful?
Yeah, and that's one of the things we're working a lot with our entrepreneurs and all the ad platform partners that we work with is actually helping them figure out what's the right media mix, right? How much of that is Twitter for like top of funnel? How much of that is Pinterest for direct response? How much of that is Instagram for a little bit of brand awareness, a little bit of direct response? How much of that is Google for direct response? So like, there's actually an efficient media mix per category, per average ticket size. There's an efficient media mix for and for size, right? I mean, a lot of brands can get to 10 million in sales on Facebook and Instagram alone. And that's actually what we see a lot of companies do is like you get started and then you start to realize your Facebook ads are getting less efficient because you're starting to saturate your audience. And you start to figure out, okay, well, where else can I go find pockets of audience I can advertise to more efficiently? And we sit in a really interesting place because we get to work with all these high growth companies and we're seeing people do interesting things like out of home, TV, podcasts, Quora, Reddit, Twitter. We don't have the answer or the playbook right now, but that's one of the things we're focused on this year is really understanding like what works, right? What's the playbook? And this is where we want to be more than just dumb money, right? We actually want to be able to help our companies really be strategic around where they spend our money, right? We're very incentivized for them to get the biggest return and the most efficiency out of that capital. And so, yeah, that's a big focus for us.
And one of the things that, Erik and I spend a lot of our time on is trying to figure out, like, when we're looking at a consumer business and you see this sort of crazy growth and all of it's obviously organic and it's all word of mouth and everything's going awesome, our fear is being fooled by a false positive, right? Where all of a sudden there's a crazy amount of growth. You kind of alluded to it where a lot of companies can get to $10 million of revenue and then suddenly they stall. are there any like signals where you're like, you know what, like this looks like it's growing really fast, but either it's a fad, it's a false positive, we think it's growing really fast today, but I don't think it's going to grow really fast tomorrow. Like, what are some of the things that when you see like in your like spidey sense turns on because you've seen it a few times where you think it's going to plateau soon? What are sort of those early indicators that Erik and I should selfishly look for whenever we're thinking about the equity of a business?
Yeah, look, I mean, I think we try and be as objective as possible, right? I think this is where a lot of VCs can run into problems is like, hey, this seems like a fad business. I would never stay in somebody else's home. So like Airbnb seems like a dumb idea, right? Like I remember I met Travis when he was starting Uber and I was like, this seems like a problem just for San Francisco where it's impossible to get a cab, but like, why would Uber ever work in New York, right? Like you apply your own personal bias to a product, both like in terms of upside and downside, right? You're like, hey, I love Peloton. Of course I'm going to pay $5,000 for a bike. And like, you don't realize that there's a very small segment of the market that would do that. I think we try and stay as objective as possible. We look at the data around, how saturated are the audiences, right? What's the relevance score of the ads? Like, we actually look at what are the objective metrics that are predictive of, a business starting to tap out on a channel. Again, like we're not perfect at it, but I think we're better than most. And we can try and get ahead of when we think a company is starting to saturate or slow down. And either, best case scenario is we introduce them to a new channel that is net new customers, right? And that's what we're really, striving to do. And if that's not possible, if they've saturated all the channels, then we basically got to get ahead of it and say, hey, look, I know you want to double your budget next month, but we don't think you're going to get the efficiency out of it. So here's what we recommend.
So we've talked a lot about sort of the companies that you're funding, but I'd love to learn or talk through your business, right? So you guys are building this origination engine, this underwriting engine, this capital markets engine. I mean, building a lending company is really complicated because basically you spend all of your time trying to get people to talk to you. And as soon as they talk to you, you're basically judging them. So it's weird. How have you evolved even your team? Like, what does your team look like? You mentioned 50 people. How many people are focused on the underwriting? How many people are focused on the servicing? How many people are focused on the capital? Like, how do you think about that? And then after that, what are the hires that you guys have made that after you made those hires, you're like, oh my God, I can't believe we ever existed without them?
Yeah. So one of the first was a general counsel who helped us navigate. So we're not a lender. We're actually building something very different than a loan or a debt product. It's a commercial contract. It's almost like a partnership contract, right? It's a rev share. It's a cap rev share that we structure. So, we will fund a company, for example, for every $100,000 we give them to spend on online marketing, we would take back a fixed portion of revenue. That might be 1%, that might be 5% of revenue until we get 106 back, right? And so that happens over 6 to 8 months typically. That's a typical structure. But, if a business accelerates, that money may come back in 4 to 6 months or 4 to 5 months. If a business slows down, that may happen over, 10 to 12 months. So we're in it as a partner, right? It's the same way that you would structure a, joint, like a revenue share partner. The only difference is once you pay us back, if you don't want more capital, you just pay us back. And then, we shake hands and like, wish you good luck. There's no sort of ongoing relationship beyond that. 80% of our companies want to continue to grow and they want to continue to work with us. And it's very easy. So we're sort of betting our business on being able to find these companies early and grow with them, until they're doing hundreds of millions of dollars. And our product scales all the way from, $10,000 to get off the ground to 10 million plus to really, continue to scale. In terms of how we built the team to support that, like I said, about half the team is focused on technology, integrations, data science, like really building a better and better model to serve the customers and making that customer experience as, seamless and efficient as possible. The other half of the team is sort of on the finding those customers and talking to them, right? Outbound prospecting, whether that's through channels like VCs, ad agencies send us a lot of referrals, some of the payment platforms and the ad platforms, we work with their sales team to send us businesses. Or we reach out directly, right? And we use a bunch of different data sources to find the companies that we like, that are growing at a good clip, and reach out to them proactively. Unlike I think what you'll find with a lending company that is spending a lot of money on ads and marketing, and then they get a bunch of applications and they say no to 90% of them, we actually try and be proactive to kind of hunt the companies we want to work with. And then we end up probably saying yes to half of them once we kind of get them through the process. And we're trying to sort of use data and some of the systems to go and hunt those companies and get them into the portfolio. And so, we bring a lot of my background, I had built a SaaS company with a high velocity sort of sales team, brought in a VP of sales that had done sort of inside sales effectively in the past. And then a marketing lead as well who had that. And then we've got a a phenomenal sort of data science analytics team that is constantly sort of pushing the envelope in terms of where we can get new signal, where we can get new data to augment our underwriting and decision making.
Yeah. How should LPs be thinking about sort of differences between Clearbanc and VC, and how does this change the LP ecosystem and what kind of return profiles, et cetera, to be thinking about?
Yeah, I mean, I think what we provide is probably much more diversified and liquid product, right? So we pay a monthly preferred return. We have right now 2-year funds. We have a lot of flexibility. We can do 1-year funds. We can do 3 or 5-year funds. So we have a lot of flexibility in the structure that we can provide. We have multiple funds outstanding and continue to raise them as we fill them up. We end up providing equity-like returns for what we think is fixed income-like downside protection, because we're cash flow based and we're getting paid back daily. So we will likely, if you're a pension fund or a large LP, we probably are outperforming your aggregate VC portfolio, but we're probably not outperforming your top 10% in terms of equity, of the returns. But we offer much more sort of principal protection and downside protection and certainty of funding and liquidity than what you get in a long VC or private equity fund.
Andrew, are there any other second-order effects that could emerge from these alternative venture models or alternative venture models approaching? It is interesting. It is sort of coming at the time where there's a lot of, I don't want to say animosity, but maybe it is animosity towards venture right now. There's this New York Times article. There was, Sahil from Gumroad wrote this piece. I mean, there's sort of a lot of, anti-VC sentiment right now, or a call for alternative models. What other sort of second-order effects could you see emerging from Clearbanc and more of these types?
Yeah, look, I think there's certainly sort of a movement happening, right? I think entrepreneurs are sort of waking up and realizing that, like, hey, this isn't actually the panacea that we were sort of promised. I think there have been a bunch of different factors that led to this. Part of it is, increased regulation on public companies, scrutiny on public companies led to companies staying private longer. A lot more money is flowed into venture capital and private equity from public markets. And so there's a lot more money chasing entrepreneurs and businesses. A lot more companies are starting to look like tech companies or at least like high growth, high margin businesses. And so you're starting to see, a lot of venture capital, a lot of dollars flowing into venture capital is starting to behave weirdly, right? And so they're chasing deals, they're ratcheting up prices, they're setting, crazy expectations. Chamath, who's one of our investors, has talked a lot about this sort of Ponzi scheme in VC where everybody's just focused on raising the next fund to collect more fees to, so they're just focused, they're telling the companies to grow faster and mark up their investment faster so they can do that. So there's some perverse incentives, I think, in VC. And I think as those become more transparent to the entrepreneur, there's getting to be a bit of a backlash. And then I think there's this realization, this movement of entrepreneurs who want to own and control. Like, people want to become entrepreneurs because they want to work for themselves. They don't want to work for a VC who works for a series of LPs. They want to control their own destiny. They want to work for themselves. And I think a lot of entrepreneurs sort of resent the fact that they now are really working for their board and reporting to a series of investors. And that's not really what they got into it for. Yeah, look, I think it'll be interesting. I mean, I think the fact that Clearbanc exists and we're seeing, the demand that we are is probably a kind of a relief valve for a lot of entrepreneurs who have kind of come to this realization that, VC isn't necessarily all that it was promised in every case.
And venture capital just branded itself really well, right? Like, yeah, these super, smart sounding people who put together like really fancy websites and brands and basically said, oh, like if you raise money from X, Y, and Z firm, you're destined for success because they have this thing called Signal and everyone else is going to want to fund you. And then they take these really cool, like, we just sort of glamorize the whole asset. And it's phenomenal. It's like so fascinating that venture capital figured a way to turn their capital into not a commodity. But it was sort of this false promise in many ways because they're marketing, like they're selling the money at people and they'd love for people to take it at a cheap price. So I think, and what you're saying in terms of for this disenchantment resonates. Or it's caused people to take in a lot of capital that they probably wouldn't take in if it wasn't for the social validation it provided.
Yeah, it's actually interesting. I mean, if you think about, you were talking about companies not going public. Imagine a public company, being like, hey, you should give me shares in General Motors at a lower rate than the rest of the public because I'm such a great investor. I mean, that's sort of, maybe that happens here and there, but like that's not really the way that it happens in public markets, right? You have a lot more market pricing and the capital is a commodity. And, I think you're right. VCs sort of said they've intuited a causation rather than a correlation, or a reverse, they're sort of saying, hey, I invested in Uber, so Uber must be great because of me, rather than, hey, I managed to get into Uber and Uber is great, and so you should let me kind of invest in your company. If you talk to, most seasoned entrepreneurs, I think the do no harm, like don't screw up my company, is sort of you're in the top, 80th percentile of most VCs. And so I found like a lot of the promise that you get from VCs is of kind of additional value add doesn't necessarily materialize. And when it does, it's probably not worth, you can probably get it from independent advisors and other people that you can surround yourself with. Probably doesn't warrant the cost, time, headache, and actual financial cost of that equity.
Yeah. So, I mean, looking out, and maybe Ali, we can start with you, 5 years out, 10 years out, what is the future of how, startups are getting funded by who and in what stages? What does VC look like? What percentage of that pie is VC? What are your predictions for what will happen? And if you could wave a wand and change anything, what would you want to happen?
So I'm pretty convinced that you'll end up seeing a continued bifurcation of venture capital firms, where there's going to be the venture capital funds that want to just stay in venture capital, like the Benchmarks of the world, the Union Squares of the venture of the world. They say, we like to have a certain size of fund. We really like investing at the stage. We're going to keep doing it and stick to our sort of knitting. There's going to be the second type of VC fund that says, we're going to become massive, and it'll be, and I've said this before, and I don't really know anything that no one else knows. But I'm convinced that Andreessen Horowitz is going to basically say, hey, we have this massive fund, we have this massive brand. We're setting up like this crypto fund or blockchain fund. We're setting up, sort of different silos of our business. And essentially what they're doing is creating PMs where they have portfolio managers called general partners who run different sort of verticals. And one day they're going to say, we should probably try to buy Clearbanc. And I don't know if Clearbanc will ever sell to them or not, but Clearbanc will have to seriously consider it. And Andreessen Horowitz will have to consider buying Clearbanc because all of a sudden they're going to try to keep growing their assets, and they're not going to be able to deploy as much as they want to deploy because Clearbanc's now limiting the amount of equity these businesses need to take in because now they have debt to augment their growth. So, I do think we're actually going to see this really odd sort of M&A happening in the venture community, especially with these massive funds where they become multi-asset managers. I think that's kind of inevitable. And when you start to see that happen, all of a sudden, as soon as Andreessen Horowitz starts trying to figure out ways to use debt financing to fund growth, or starts saying, hey, we're going to do token finance instead, that's going to create specialized niche type funds. And they're going to say, hey, it's going to be like the Circle Ups of the world to focus on CPG and just get CPG right. And they're going to fund the equity of these businesses and the debt of these businesses, et cetera. You're going to have the Clearbancs, and they're going to own the e-commerce world. And they're going to, if I had to guess, and I don't, again, it's not that Andrew and I have talked about it, I'm convinced Andrew's going to come out with 10 other products that are all really smart. And he's going to learn 19 other things. And by the way, maybe he builds an ad agency that they contract with because they're going to have so much first party data that no one else has on how to grow your business. So I think that people are going to start to realize that companies all are built differently, and having one VC fund that's structurally built to back SaaS companies and using the same fund also back e-commerce companies and CPG businesses or businesses that may never actually get to $1 billion of enterprise value because it's a little bit more niche. You can't do that out of one fund. And so I just think we're going to see all kinds of different products being used. Some of those products will come from the sort of bulge bracket asset managers that'll end up, that today we call VC funds, but tomorrow we'll just call asset managers. And some of them will come from specialized firms as well.
So yeah, I don't plan on selling to Andreessen, but always happy to chat with those guys. But I think it's interesting.
I said they'll try to buy you. I didn't say that you'll sell to them.
Yeah, and I think it's interesting. I mean, look, my perfect utopian future is all of the money that's in venture capital goes to solving truly, truly hard problems, right? I think that would be phenomenal. If it's instead of, MBAs running spreadsheets, trying to figure out CAC to LTV, they're funding 10 companies that are trying to cure cancer, develop flying cars, extend life, get us to the moon, solve the energy crisis, right? I think those are the outsized bets that equity is uniquely designed to fund. And so my utopian vision is we actually help sort of reorient all of this venture capital and all this talent that sits in the space and all this capital to really solving the hard problems that equity is uniquely poised to solve. And then we sort of help the rest of the entrepreneurs, right? SoftBank is funding $100 billion, but in $100 million increments. We want to do the same, but fund it in $10,000 or $100,000 increments. So, several orders of magnitude more entrepreneurs touched globally. And I think a model like us is well suited for most of those. And then the Elon Musks and the people that are really trying to swing swing for the fences around moving humanity forward, they should get the concentration of venture capital, right? We should have 10 times as many of those. I think that would be a phenomenal future.
Yeah. Ali, can you talk a couple minutes about the future of CoVenture? Where do you guys sit 5-10 years out? Is it sort of the Andreessen model, but just a few years behind because they have a head start?
So we're really good at figuring out what we want to do today. We're not so good at figuring out what we want to do 5 years from now. And then we sort of have this dream of what one day looks like. I think today we like to take what Andrew said, equity investments in businesses where there's real uncertainty, where they're going to take the capital and they're going to do something with the capital today. But tomorrow they might do something completely different with the capital, right? If I give someone debt financing, I kind of know what they're going to do with it, right? I'm like, all right, you're going to make, loans to e-commerce companies and you're only going to use capital for that. Great. If I fund somebody with equity capital, they can do whatever the hell they want with it. And so it's nice that we have this ability to back the equity of businesses out of that fund. That being said, we think that CoVenture is an interesting firm to partner with, although it's massively biased, because not only can we provide the equity financing, but once we're your partner there, we can provide you all these different types of facilities, whether it's a revolver, a forward flow agreement, an off-balance sheet fund. We can take your assets off the balance sheet and do interesting stuff with it. And I think that we're a firm that's really focused on comparative advantages, where we like to think that we're good at credit, but there's other people who are good at credit. We definitely know we know more about venture than all our friends in credit. We like to think that we're good at venture, and I think you're good at venture, right? So, but there's a lot of people who are good at venture. We're definitely better at credit than all of our other venture friends. That's just our thing. And so if we can continue to build a firm where we're winning on comparative advantages by knowing something different, not just the same. If I say something about a credit deal, I probably sound somewhat insightful compared to all my other venture friends, but compared to another person who's been building specialty lenders for their whole life and does credit, I'm just saying the same thing everyone else in, especially finance and everyone else does. So I think that's what we ultimately want to do is say, what do our companies need? How do we almost build this rainforest of financial products for those companies? And actually maybe Andrew will build a business that will collaborate with in a million different ways and co-invest with in a million different ways. I'd like to think that I'm one of the VC firms that sends deals to the West, because if I'm in the equity of a business and I'm not set up to quantitatively underwrite the growth of an e-commerce business, basically by bringing Andrew in, I'm just levering up my investment. And what's better as a venture investor than levering up your investment with non-recourse capital? I mean, of course I'd do that. So, we want to kind of build that rainforest of financial solutions for startups as they grow.
Last question for you, Ali. Of course, the other innovation in alternative finance, what people think about the last couple of years has been ICOs. People have been talking about crowdfunding for a long time. Ali, one, what's your quick take on crowdfunding or ICOs? And two, is there any other alternative finance models that don't yet exist that you think should exist that startups should be using or should use in the future?
It's funny. In 2017, all ICOs were awesome. In 2018, all ICOs are horrible. And, it looks like everything. It's sort of in between. The two reasons that you should issue a token is, one, if you believe that you're going to issue a security token, and issuing a security token is a really good idea because you feel like you have a body of investors who would pay a premium to the price of preferred equity because they value the liquidity more than they value the governance and liquidation preferences of preferred. If you have an investor base that would, buy into your equity at a higher price, if they had some sort of transfer rights and liquidity mechanism, and they were optimistic that with those transfer rights, there'd be another buyer sometime in the future and gave them optionality, you should definitely sell your equity that way because you're basically selling equity with less governance at a higher price. Okay, so that's one reason. And if you're a buyer of that equity and you feel like, hey, that security interest still gets you the future cash flows of the business, but you value your liquidity premium because you're not really sure about what SoftBank's going to do and will companies ever go public again and everything else, maybe that's a rational reason to buy that type of token. In terms of a utility token, I think the reason that you issue them, and not all companies should, but if you're building a project and your project relies on many, many different people all sort of contributing to it, and you want some way to incentivize them to contribute to it, you give them a token, and then you charge all future people who use the project later some tokens to use it, so the people who help build it capture the rent. And instead of all the equity value going to the creator of the original asset, you're taking those economics and then passing them off to all the people who contribute to that open source project. Those are the two ideas of token issuances. Both of those ideas are still here. I don't really know why people think they're all bad now, just like I don't really know why everyone thought they were all good in 2017. I still think crypto is going to take off. And I'm buying more now than I was buying in 2018 when it was super overvalued. And, the meetings I'm having now are actually with a lot of people who are oh wow, this like token thing, maybe I'll buy in again. So the sentiment has really changed even in the last 30 days than it was 5 months ago when everyone was super bearish on it. In terms of the last thing that I think it's interesting, I try to like leave each time we talk with like one new idea. I am really interested in these soft like IP type assets. And so one of the things that I'm looking a lot at right now is, right now it's illegal to try to sort of take economic gain by building Spotify playlists. But I do believe that Spotify playlists are the new radio stations, and radio stations have historically been profitable, right? There's like real businesses that have been built on top of that. And so one of the things that I'd love to one day do is build a roll-up of the top Spotify playlist, because that's how people discover music. And then one day sell that roll-up to a talent agency who would then want to say, hey, Mr. or Mrs. Artist, I will sign you. And if I sign you, you will then be on, we will then be able to distribute you across all these different Spotify playlists that have all these different followers. And the fact that we signed you is what's going to make you successful. So that's like the next asset that I'm kind of interested in.
Awesome. I want to be sensitive to
guys, I got to run, but I appreciate it all the time.
Awesome.
Awesome. Thanks, Ali.
Thanks, guys.
Awesome.
Love it. I agree with Ali. Ali's, I'm very bullish on crypto for those specific use cases, right? I think the transparency and liquidity for securities is incredibly valuable across sort of, capital markets broadly, right? I think there's been a huge lack of transparency. It's what led to the financial crisis. Being able to actually have full transparency and third-party liquidity, I think, allows you to sort of price find for asset prices much more efficiently. So big believer in that. On the utility or consumptive token side, I think there are a few super interesting use cases, but most of what I've seen are sort of trying to force something into from a regulatory perspective, fit into a box. And so, look, I think for entrepreneurs to be able to have different avenues to raise capital and to incentivize different stakeholders is always a positive thing. I love, I've always been a fan of crowdfunding. The idea that you can pre-sell a product without having to take the huge amount of, inventory risk is incredibly valuable. The question around, how much of a increased benefit should those early backers get for that product really depends on the product and how much risk they're really taking. If it's a product with a high level of certainty that it will get produced and delivered, then there's probably not that much risk they're taking. And they, if they get a discount for backing it early, it's probably worthwhile. If there's a, significant R&D type effort and they're pre-buying your product, which is sort of what the consumptive token is supposed to represent, then I think they do deserve more equity-like returns because they're taking equity-like risk. But no, I think that's super interesting. The Spotify playlist is an interesting one too. I haven't really thought about that. I do think I think there's something interesting around Amazon brands and an equivalent, being able to build rankings within Amazon or Alexa, being top of when people search for toothpaste or whatever. I think is valuable, and we're seeing sort of people look at roll-ups for those DTC brands and those marketplace-based brands, which is another sort of equivalent to building on top of an existing platform and creating economic value on it.
I'll ask you the same question I asked Ali. Looking out 5-10 years, what sort of new products could you see yourself releasing, and what's the big vision for Clearbanc in terms of what does it look like? Yeah,
so look, our mission is to help entrepreneurs be successful, use financial services to do it, but help them achieve their dreams without the headaches of like thinking about their financing. What that means in practice is, right now we're funding customer acquisition, but if you think about the P&L of a business, you have a number of repeatable, directly tied to revenue line items, right? And that may be, for an e-commerce business, that could be customer acquisition, shipping, inventory, and then you have some things that are variable like product development or warehousing or, some fixed costs. For a SaaS company, that could be payroll, right? They could be marketing and payroll and sales commissions that are all sort of variable and tied to revenue. That right now equity is plugging the hole to say, if you don't want to wait and grow slowly based on cash flows, we will help you accelerate that growth today. Clearbanc wants to step in and say, look, for all of those repeatable things where you have a pretty good sense around what $1 in equals, how many dollars out, or at least the parameters around, the high and low bounds of it, for every line item we want to be able to fund. And so we're building out products to be able to fund, everything from inventory to shipping to, eventually we'll fund payroll and other things. But we're focusing on customer acquisition because that seems to be the biggest need and the biggest opportunity right now. The other big focus for us is internationalization. Right now we're focused primarily in North America, where there's still a huge problem in access to capital for entrepreneurs. But as you think about, international markets, there's even more of a challenge, right? UK and Europe, there's less of a developed venture ecosystem. Banks are much more conservative. Places like India, there's personal guarantees associated with equity investments. So you put your house on the line, even if you take venture capital, which is totally absurd and unfair to the entrepreneur. So we think there's a huge, exciting opportunity in sort of the global market where we can help entrepreneurs globally. And the fact that we don't need to go and meet you or know where you went to school or get a background reference on you, and we can just look at the metrics of your business, allow us to do that uniquely. And so that's what we're particularly excited about. Diversity is important. We value diversity in thought and in the types of people we hire in the company, but we didn't have a diversity mandate when we built the company. But what's happened, because we've removed this bias, because you don't need a warm introduction to us to work with us, because we don't care about where you went to school. We don't meet most of our entrepreneurs face to face, or at least not until after we've funded them. We've taken a lot of the bias out of the decision making. And so we funded, I think, 8 times more women than the average VC. We funded people in Middle America, Idaho and Utah and Florida, where they're in Baltimore, where there's not a developed venture capital ecosystem, and who otherwise, would have had to, take a second mortgage on their home or ask friends and family for money. So I think that's one of the exciting things is there's a huge amount of untapped entrepreneurial talent and potential that hasn't even, been able to dream or take the risk or have the ambition that they could if they had access to a product like ours. And, I think, I'm, again, hopeful that products like ours that are as much as possible taking a lot of that subjective bias out of the decision-making help solve a lot of the, gender, race, economic class, diversity challenges that I think we've seen in the venture capital ecosystem. And, it's not by any sort of proactive mandate, but it's just a byproduct of looking at data and objectivity rather than subjectivity.
Totally. Awesome. Well, Andrew, thank you so much for coming on the podcast. This has been a great episode.
Yeah, no, this is awesome. This is a lot of fun. Thanks a lot, Erik.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.